Welcome, everyone. Just in case, since this is the first breakout session of the day, you are joining Pathways to Retirement. This is an overview of retirement plans. We're glad you're here. We're glad you're chosen to be with us. My name is Celia Langford. I will be a co-presenter today, and we are going to go ahead and get started on our program. And I'm going to pass the baton over to my co-presenter, Ian Walsh.
Thank you, Celia. So thank you for deciding to spend your time with us here. This presentation is called Pathways to Retirement. Now, this is a basic course, so we aren't going to be going into a lot of the specifics as to some of the more complicated aspects of retirement plans. But we do want to get everyone accustomed to terminology. We also want to let them know what they might see as an auditor, as a tax preparer, as an individual planning for your own retirement, or what you might see as an employer. Now,
just a moment. I'm trying to get it to move. There we go.
You need to
Can you see anything? What can you see now?
Go ahead and hit slideshow, Celia. Go ahead and.
What can you see?
From current slide, second over from the left on the top bar.
Yes. Okay. Uh-huh. Is that what?
Now that's a full screen view for everyone.
Thank you. I'll try to keep it moving. I always need help with the technology. Thank you.
Well, that's what we're here for. 2020 has been a year for technology, to say the least. So thank you all again for coming to join us for Pathways to Retirement. As I mentioned, we're going to discuss some of the basics regarding employee, employer, individual, and also company-based retirements. Now, when it comes to retirement, a lot of people are probably thinking about their 401k. But throughout this presentation, we kind of want to talk about the introduction, how retirement plans have changed over time, what makes them so complicated, how this might affect you, and then some basics that you might need to determine when either funding your own retirement plan or that can help you find the resources needed to set up and continue with your retirement plan. And then lastly, we just want to talk about some of the the ever-changing rules and landscapes that governs the tax code, but just talk about some of the newer tax acts and what effects they have on retirement.
And as we're going into the next slide, I would like to point out we had two resources available. One is the actual PowerPoint that you're going to see on the screen, but we have a much longer resource that's available that is really intended to give you more details and more real resources about the retirement plans and what's available. It's pretty long, but you can certainly, it's available online, so you can scroll through it. I tend to sometimes print these onto like 4 page, so we're not wasting quite so much paper.
Mm-hmm. Absolutely, and that's an excellent point. So as we go back to that, our slideshow is supposed to be a little bit minimal. We'd rather have some interaction, and if you have any questions, feel free to raise your hand in chat so that we can answer them. We have allotted time at the end of each section to discuss questions. So we will be monitoring them throughout the whole presentation. But in short, I'm going to go back into the introduction. So retirement is a big deal for us simply because it is the largest expense that most Americans will see during their lifetime. And on average, the life expectancy is continuing to increase, and Americans live greater than 15 years after they stop earning income. So this means that in order to have the funds that you require to enjoy whatever you want to do in your post-employment years, you have to understand what costs go into your retirement. You have to understand how much you expect to retire on and what you expect to be able to take out during any given year. And we'll talk a little bit more when we go into the history about how that responsibility shifted over time, and what we see nowadays is commonplace in the workforce. Now, when we go into a little history, this is just talking about what happened with retirement plans and how it started. So a lot of people, when they hear retirement, they think about Social Security. Social Security is something that we constantly buy into and we're reminded about in the news every day. One of the largest concerns that people have is this underfunding of Social Security. And some people have a conception that Social Security was meant to be a retirement plan, but that is not in any way, shape, or form what was intended with Social Security. Social Security was initially brought about with the law of averages, and so they expected that most people wouldn't see this retirement plan and the Social Security funds drawn out over their entire life. And as you can see here, this is coming directly from the Social Security cost of living adjustments taken directly from Social Security. But when Social Security was enacted, this happened back in 1935. And I know it's hard to remember 1935. Heck, it's hard to remember beyond 2020 at this point because so much has changed. But the average life expectancy back in 35 was 60 years. You were expected to live until you're 60. And they had set this retirement age at 65. So essentially what was happening was this was a way to sort of supplement people once they had retired, but it wasn't expected that people would draw on Social Security. So it was never enacted to be a retirement plan in and of itself. But nowadays, we're kind of looking at seeing that the people who did live after 65 expected to live another 12 years. Now, this was, in essence, for this small percentage of Americans who outlived these odds is what Social Security was meant to be. And as you see nowadays, our life expectancy is continuing to grow beyond that. And we'll talk about a little bit later when we come to what's new, some of the changes that we're seeing with withdrawals and that this lifespan and this expected retirement age is continuing to increase. And that's largely because Americans need to have additional money, and there's a lot of concern as to whether Social Security is something that can be relied upon, whether it will even be there for people once they do retire. So when we get back into retirement plans, we're going to go way back before Social Security. Retirement plans initially started with pensions, and they were seen for especially governmental workers, policemen, firefighters, back in the mid 1800s. And then we saw American Express, which created the first private pension plan in the US in 1875. Now, then we have to get back from seeing this and saying, when did tax come into play? Because tax is now a very important aspect to consider with retirement. And taxes came about in 1913, which was when the first income tax actually came about. And something that was important for the government, and you'll see this commonly with the tax code, is that they try to incentivize certain good fiscal behaviors. And one of the things that they've tried to really incentivize is retirement. So we'll see when we go through this, these are all code sections that were enacted in the tax code that are meant to encourage both employers and employees to create retirement plans. But initially, what we saw was these retirement plans came as a way to incentivize and retain talent in the workforce. And that's still a common trend that we see today. So as we'll see, the pension plans sort of continued from 1919 through the 1940s, and we can see that this increase. Oh, sorry. I see. Celia, are you sharing your screen? Celia?
Just to let you know, we're only using the slides intermittently.
Okay.
Basically, you have access to the guide that's much longer and goes into a lot more history, but we're trying to keep the slide part down for this, so you won't always see slides. We're going to share as we need.
Yes, and so if you go into where we actually joined, you will see that there are links to download the slides.
But there are also links to download the reference manual, which is far more informative.
Right. Uh, and so really what happened was because there was this large amount of retirement plans and there wasn't any sort of regulation, we saw that there was a lot of problems with these unregulated plans. And so these employers were doing some things that were considered taking advantage of the employees. And so at some point, because these retirement plans were such a big portion of what people were receiving, it became important for the government to step in and create some sort of guidelines for what you can and can't do with a retirement plan. And so when we get back to the previous, when we get back to our history, we're going to talk about some of the common features that we saw with early pension plans, and those included these long-term vesting schedules, about 20 to 25 years. And there was also favoring for these key employees, and we'll see that when we talk about some of the regulations going forward. But largely, one of the big problems was there just wasn't any accountability. Employees did not have the clear view of what was going on with the retirement, and so the government had to step in. Now, when I talk about these long-term vesting schedules of 20 to 25 years, as you can see, this was a major way to incentivize employees to stay with the company. And now we see a much shorter vesting schedule. Commonplace is normally around 5 to 7 years, and that's what you see now. So examples of broken promises, Studebaker, as you can see on the slide on the right, less than they promised, the airline industries and the steel industries. Now, as you can see on the left, we have this movie, Fun with Dick and Jane. I wouldn't call it a critically acclaimed movie, but does anyone kind of know the premise to the movie? Feel free to go ahead and type it into chat if you can. Well, I guess I can always go ahead and spoil it for you. Unfortunately, I think it's been around long enough that I don't have to create a spoiler warning. Right. So as Robbie said, they did lose their jobs, and Fun with Dick and Jane actually came about, and it was talking about Enron. So one of the things that we'll see and we'll talk about in retirement plans are sort of employee stock ownership plans. And that was something that happened a lot with Enron when they did do their matching. And this is what would happen is when an employee contributed money to their funds, Enron would match it with company stock. And so what happened was these employees thought they were receiving a large amount of company stock and they were getting a great bang for their buck because at the time Enron was doing phenomenally on the stock exchange. Only later did we find out, sort of, and this is a cautionary tale for any sort of these employee stock ownership plans, did we find out that they were cooking their books. And so this was another reason why a lot of these employees lost their entire retirement plan. It all just went out the window because they had so much of it invested in this company stock. And so in response to these things, we see Social Security was enacted to these broken promises. So essentially, it was a way to kind of ease the burden for these employees who were taken advantage of by these systems that were in place beforehand. So nowadays, we see that the largest component of retirement plans is really talent retention. Nowadays, you have to offer some sort of retirement plan if you want to keep and maintain the best talent. And so it's a very important part of any business owner, and also as an employee, understanding what kind of retirement plan that you are eligible for. But essentially, what happened was we saw this shift to all these regulations, largely in response to the government wanting taxes. Because the way that these retirement plans worked was employees who contributed the money could either take a deduction from their income in the current year and defer it until they retire, or they could pay the taxes on it now and get it tax-free from retirement. But on the company end, they were also getting to deduct their employer contributions for the retirement plan. So the government was not actually getting those taxes. And so they had to set some sort of a framework as to when these taxes became due. And we'll see that commonly we hear about 401k provisions, and those came about with the IRS code 401k. And now I guess is a great time to pause for our first code word, which is thrive. 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 Okay. Now, the one thing that I will say about the IRS Code Section 401k provision was they sort of shifted this burden. Typically, what we saw was this idea of a defined benefit plan, which states that once you retire, you're guaranteed a certain amount of money from your employer throughout all those years of retirement. And the IRS Code Section 401k actually shifted this burden from being in the hands of the employer to the employee. And that is something that was largely beneficial to all of these employers, because as we'll see as we go on, there is a large cost associated with maintaining these benefit plans and these retirement plans. So this move has really become the commonplace trend, is to having these sort of defined contribution plans as opposed to a defined benefit plan. That's what we see nowadays. And those are all things related to this IRS code section 401k. Now, if I could take a brief moment, just does anyone have any questions at this point? Feel free to type them into chat or raise your hand. And if not, I will turn it over to Celia.
Thank you, Ian. And just to recap, that's important, especially what he worked on at the, talked about at the very end, was the importance of going from a defined benefit plan, which was important and used in the 60s and in most years as the regulations increased, and then into the 70s and into the 80s, they wanted to shift the risk from the employer with a defined benefit plan over to the employees with less cost as expected from the employer. So they went to these defined contribution plans and these 401k plans. Defined contribution means you can put in a percentage, but you don't have to lock in exactly what the employer has to pay. And 401k means that the employee gets to defer part of their own money at a tax advantage way. So I'm going to see if I can advance my slide. Why so complicated? That's our next section. And our next section for that, I'm going to stop screen sharing and you get to see my face. Ian, I'm going to let you close your video, and let's see if I can do that. Then we'll stop the screen share. So the big reason, can everyone see me? Hopefully. Let me get my
Actually,
video
Celia,
going.
I do not see.
Yeah, let me get my camera on. Sorry about that. All right. So the reason that it's so complicated is very clear. It has to do with the taxation that Ian referred to earlier. The reason that retirement plans are so complicated is it's one of the very few ways in which money can be put into a fund and it doesn't get taxed for many, many years. And so the IRS is like, okay, if we're going to allow you to set aside money and we're not going to tax it for, a long time, we want to know that that money is safe so that when it is time for it to be taxed, we know how much is there. So that's the motivation for why it's so complicated. The reason to understand is that no tax is assessed on qualified retirement plans or the related earnings on those plans as long as they remain in that plan. So it's deferred until the money comes out. And for us as tax preparers, that means it basically remains there until you get a 1099-R. And for us preparing tax returns, that 1099-R is the key to the kingdom of the IRS saying, oh, okay, now we get to tax those funds. When retirement plans started, again, as Ian referred to, a lot of them were done when people stayed in one job for their entire career. But another reason it's become complicated is that people now have mobility with jobs. You are not required to stay with one employer. You're not expected to. So you could have a retirement plan or different retirement plans based on working for different employers. So there may be more plans out there. And then the last thing is, again, because you may have different retirement buckets or you may be deferring over your entire career, it could be decades that money is sitting in a retirement plan and the IRS is waiting for it to come out so that they can tax you on it. So those are the three real big factors that talk about why it's so complicated. So those are the three factors. And I am going to also see if I can screen share. The other part to understand is because it's so complicated, you're going to see, let me see if I can screen share. Sorry, guys. What we come to, that you can have retirement in several buckets. You could have your Social Security. You could have your retirement plans. So I'm going over to the screen again. Also, the thing to know is because it's so complicated, there are a lot of rules. Our retirement environment is governed by the Employment Retirement Income Security Act. Hopefully you're seeing that, which dates to 1974. It started at 200 pages, and now it's over 4,000 pages. So clearly there's a lot of complexity to it. Can you see that screen? Hopefully.
Yes, I think we can all see it, Celia.
Good. Okay, I'm going to try to move to the next screen. There's our retirement buckets. I wanted to get to those. So you could have an IRA retirement bucket. You can have a qualified plan that's coming from an employer retirement bucket. You could have a Social Security retirement bucket, or you can have multiple retirement buckets. So it's important to recognize that your funds for planning for your retirement and for your life of leisure after you stop earning a paycheck can come from many sources. I'm going to take it and hand it back over to Ian to our next area.
All right. Well, thank you so much, Celia. I think one of the reasons why it's so difficult to plan for retirement is because there are so many buckets. It's hard for any one individual to know exactly how much is in each of these buckets, and sometimes I feel like it's almost a surprise when you see a 1099-R and you're like, did I actually have that retirement fund? But yes. So our next section is called How Does This Affect Me? And our goal is to just sort of talk about ways that you may interact with these retirement programs as an auditor, a tax preparer, as a trusted advisor, and what you might see as an individual. So first, let's go ahead and go through. And I think one of the most complicated aspects of a retirement plan is simply all of these terms that we see. We hear all these things: defined benefit, defined contribution, SEP, simple, safe harbor, 401k. All of these different things are all just these terms that have complicated legal definitions or are actually dealing with these IRS code sections. And so it's very important that we kind of understand that these retirement plans do have very complicated reporting requirements that you do have to qualify with. And we'll see a little bit later in a couple of slides, we talk about Form 5500, which is typically what you'll have to file if you have a retirement plan that is greater than 100 employees at the beginning of your plan year. And that's another thing that gets complicated, is sort of this timing for what goes on with your retirement plans. But there are provisions, as we talked about, that were made to directly counteract these problems that we saw with these retirement plans before they actually enacted these things in the 80s. So one of the commonplace things that we hear now is this 401k plan, and we talk about it a lot. I think it's really kind of this gold standard that we see for a lot of employers. Now, this 401k is also a very important thing that we should know about as individuals. But there are certain things that we have to meet for testing requirements. And one of the key things that we'll see is this notion of discrimination testing. And when we get into our next slides about auditors, we will see how complicated these benefit plans can be and what these additional disclosures might cost to an actual company in order to maintain them. But just a couple of other things that we would talk about there is like safe harbor. This notion of safe harbor is something that is a means of getting around these additional reporting requirements, and we'll see those on later slides. This Form 5500 is largely what is related to when they talk about safe harbor, and we hear about that.
Sorry about that.
No, that's all right. And so that's just something that we need to consider, is this notion of how much will it cost us for compliance? Is this right for me as an employer? And also, what kind of benefit are you providing to your employees? You know, it's a very important thing for us to consider as an employee, is where we want to invest in our retirement. And so it's also a very key component of sort of that hiring process as well. So now it's time for our second code word, which is Cancun, which I think everyone agrees we might prefer it to the snow that we've seen. But that is Cancun, C-A-N-C-U-N, Cancun. Now, Celia, if you could actually go back to that slide, that the Penn State one that you showed real quickly.
Sure, if I can go backwards, it's giving me some trouble, but I'll see.
Can you just hit the left arrow on your keypad? Will that bring you back?
I don't have an arrow anymore. They disappeared.
If you just
I'll go to let me see if we'll go to the previous, this one?
perfect.
All right.
Yes.
Yeah, thank you.
All right. So I picked this up from the Penn State Financial Literacy series, but I thought this was an excellent graphic just to kind of break out and put in a visual representation what we might expect to see with retirement plans. So obviously, as you see in the top, we have this idea of retirement plans, and then we see that we have ones for your self-employed individuals, and then you have these individual plans which have no additional requirements, and then we also have these employer-sponsored plans that are on their own, and these have a lot of additional requirements to them. But you see on the left side, we have the individual plans with your traditional IRAs and your Roth IRAs. And I think we talked about this a little bit earlier, but there are some benefits as to when you're taxed for a traditional IRA versus a Roth IRA. Now, a traditional IRA, you can take it out of your adjusted gross income in the year that you make the contribution, and so you don't have to pay taxes on it. But once you actually do receive that 1099-R coming out of your retirement account, you will be paying taxes. And so as we sort of talked a little bit in our first conversation, I think David Harris had spoke a little bit about why we might want to consider going to a Roth IRA and why that might be beneficial in the current year because everyone had these hardships related to COVID. Now, the idea of a Roth IRA is basically that you pay taxes on it now at your current income tax rate, and then the money that's in that account can grow tax-free throughout its lifetime. And so that's a very important notion that we'll also talk about in a couple of slides when we talk about Form 8606. And we'll come back to that, but that's that notion of what's taxable and what isn't taxable. Now, self-employed and small business owner plans, typically when we're talking about that, I think this 100 employee limit is a very important concept. So typically when we talk about a small business, we're talking about that sub 100 employee threshold. But they do have these plans, set plans and simple plans. And I just want to make it clear, these are also both types of IRAs. But what makes them different from these employer-sponsored plans is that typically they don't have the same burden of filing this Form 5500 on an annual basis. They're a little bit simpler in the compliance side as opposed to what we would have to go through with these larger plans that we'd see. And now, then we talk about these employer-sponsored plans. We talk about benefit plans, contribution plans, thrift savings. And we'll touch about them a little bit later. So now, how does this affect me? So first, we talked about it as an auditor. So employee benefit plans under the ERISA include audits of plans that begin their plan year with 100 or more eligible participants. And so because of that, they do have to have certain compliance testing with these audits that are actually pretty stringent. And that this goes back to making sure that we meet our fiduciary requirement as an employer. So when you're holding this money, you do have a fiduciary requirement. So another thing to talk about when we come to this notion of a trusted advisor is this 100-person threshold. Is this company that you're talking about, are they planning on hiring and are they expanding? Is it possible that they might actually have additional requirements that they might need to consider if they've crossed this threshold? And so it's very important to understand that there's a lot of complications regarding these benefit plans, and it is important to have someone who does stay up to date on these ever-changing rules and landscapes that we deal with. And this is actually treated as a specific niche. And we mentioned this, a lineal global, that's what we sort of, it's a bunch of private firms who come together to sort of share their expertise. But it is a very important notion that this is a niche in and of itself for accountants. So some people can build their entire livelihood just about dealing with the complications that come with these retirement plans. So another thing, as an auditor, what might you see with these plans outside of an employee benefit plan audit? You will also see that you do have to account for this money differently. Employer contributions, employee deferrals, you might not actually have rights to this money. So it might not be an asset on your books. In fact, it most likely is a liability. It's something that you're going to have to pay out in the future. And so you have to be aware that you have to account for it as such. So this is something that you're going to have to disclose specifically on your financial statements. And so these are something that you want to look into, is whether the company is accurately stating that we have X amount of liability to our employees as a result of this retirement plan. You want to make sure that those numbers match up. if they say that the retirement plan they'll match up to 4% of employees' salaries, you might want to look back and say, all right, what's their salary figure outside of maybe their ownership? They might have a different plan in place, but what does that look like? And now, can I take that amount and can I multiply that by 4%? Do I see that number appearing anywhere in their financials? Can I trace that back? Does it look like they're accounting for it appropriately? So those are a lot of different things that you want to consider. And another thing, going back to that history, was that a lot of these plans were massively underfunded. So when we came back to this notion of employer contributions, some employers weren't actually making these contributions. They had and this is a large amount of accounting, is these pension liabilities on their books. And so another reason why we have the Department of Labor stepping in is to make sure that there aren't any misleading promises that employees might think, oh, I have X amount coming in retirement, but really there's no money in the company. Nothing's been set aside for their employees. So that's another portion that we're going to consider when we come into this testing and Form 5500. Now, as I mentioned, this Form 5500 is something that's required to be filed with both the Department of Labor and the IRS. And there's a lot of disclosures that come with it. And there's a lot of timetables throughout the year regarding these retirement plans that you have to meet. And if you do fall out and you do miss one of your legal obligations, you might have to remedy some things within your plan. And if you can't remedy them, you might have to disclose them. So these are a lot of considerations that you might have as an accountant. But as we mentioned, there are two different branches of the government that are actually looking at these plans. And that's the Department of Labor and the IRS. And for very different reasons. The IRS, as Celia mentioned, is looking to make sure that they know how much tax revenue they're going to come in, make sure that no one's getting away with all these retirement plans that are set aside and they're beneficial. They're missing out on the corporate tax rate, the individual tax rate, and they're setting that aside for whatever their lifespan is as an employee. And then also the Department of Labor, for the reasons we're talking about, making sure that you're not discriminating against employees. And we'll talk a little bit about that. But with this Form 5500, there is this notion of discrimination testing. And a lot of it comes down to this notion of have you actually put in actual contributions that meet up with what your actual liability is? Have you actually been paying in what you're expected to? And additionally, you have two different buckets that you want to make sure that you're not discriminating on. And those are these highly compensated individuals. I guess they call them, I believe, HCEs. And then in traditional tax ways, they mention these non-high paid individuals, NHCEs, which is essentially defined as people who are not these highly compensated employees. And so that's how they kind of govern those. But they want to make sure that their plan isn't simply to harbor this money in a way that's kind of providing sort of a tax shelter for these owners so they don't have to pay taxes for a long time. So those are areas of compliance that you have to meet with your annual Form 5500 filing requirements. And now, as a tax preparer, you also have to be aware of that, because as I've kind of mentioned, these employers are allowed to deduct it on their tax returns. So as a CPA, you want to make sure that that number that you see, you can trace that back. So really, the best policy is to confirm with the client that they have made all of their required contributions, and make sure that that number that you're putting in there and deducting on your tax return, you want to make sure that that number actually is derived from your salary figure. You want to make sure that that's very reasonable, and if not, you really want to touch base with your client and make sure that they know that. But back to what's disclosed on this 5500, it basically talks about the plan's financial condition, what kind of investments in the operations, and that's kind of to be expected with people on these brokerage accounts. Is they kind of want to know how their investments are growing over time. And another thing is they want to make sure that these employers meet their fiduciary responsibilities to their employees, that they are accurately segregating what amount should be for each employee, and each employee has access to know how much do I have to set aside for retirement. That way they can make more planning decisions as an individual. So typically as a tax preparer, we talked about this earlier, Celia touched on it briefly, we typically work with and see these retirement plans come into play on a couple of different tax forms. The first one being 1099-Rs, which is really the most common way that we see these retirement plans. And when we see this, we'll see this taxable amount, and they split it out there. They say a gross distribution, a taxable amount, and those are important considerations that we want to take into consideration when we're doing that. Because with our taxable figure, we're expecting that taxable amount, and that should be flowing through into our adjusted gross income. Now, as we kind of mentioned, and you can see here, you have a Roth IRA and then you have a traditional IRA. So typically with a Roth IRA, you're going to see this gross distribution number, and that's however much came out of your brokerage account, but your taxable amount is typically zero because you pay taxes on it when you initially put it into the account. And that's sort of the benefit of that Roth IRA, is you're going to have no taxable amount coming out of it. Now, with a traditional IRA, we typically see that gross distribution and that taxable amount, those should be the same. And we kind of mentioned a little bit earlier, and we'll talk about it on the next slide, I believe, is about this Form 8606. Now, Form 8606, oh, sorry, actually, I'll talk about this real briefly, is other ways that we might see this interaction with us on our tax return is on our Form W-2, Box 12. And you can go to the next slide, Celia. And then another place that we see it come through is on our Form K-1s. We see that in that Box 13, other deductions, and that's where we'd expect to see those retirement plans coming through. But as I had mentioned, how does this sort of affect me as a tax preparer? Form 8606 is something that we need to be aware of. So as with anything, there are certain thresholds that are set in place for individuals to make sure they don't take advantage of these benefits. And Roth IRAs are a very powerful tax tool that we use to save for retirement. And so as such, there are some limitations that we'll see. And I believe Celia will touch on these amounts. And there's an excellent table later on in this presentation that you can look back on to see these figures and what you might need to consider. But essentially, Form 8606 is a means of tracking basis in retirement accounts. They want to know how much of your money in there from your Roth IRA is taxable, how much is non-taxable. And so when we talk about this idea of a Roth conversion, which I think you heard a little bit earlier with David Harris talking about it, that's a way for clients to go ahead and pay taxes now so that when they retire, they don't have to pay taxes on that income. And that way, you kind of know exactly how much money you're going to get out of your retirement accounts. And obviously, we can't adjust for that cost of living increase, but it does give us a better idea of exactly how much we should expect in retirement. Because clearly, we can't figure out what the tax rate is going to be because we see this turnover as we're seeing nowadays with politics. We're seeing this change from these party systems. And so we really don't know what the tax law might look like in the future.
Ian,
So
we'll take one quick break for another.
Yes, sorry. Next code word. And our next code word is qualified. 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 As you can see, I guess apparently we lost our code word. Apparently it was already taken, and I didn't realize there was a one-to-one word requirement for these like for these CPE credits or whatever, it's code words. Yes, great minds do think alike. I think that's how you know that you're thinking like a partner is when you come up with the exact same word for your CPE slides. So I think everyone has had a chance to sort of write that down. The code word number 3 again is qualified. But lastly, we want to talk about being a trusted advisor. So what you can do as an accountant, whether it is with your as a CPA from a CPA firm, or if you're actually working within your employer, what kind of considerations can you have, and what kind of value can you bring to the table for your employer? So typically, when they have these plans, there's a lot of complicated legal speech that can be brought into it. And so it's very important that as an employer, you understand that you have this fiduciary responsibility to maintain this money and to grow it as if it was your own. That's really this concept of fiduciary requirement, is that you're not mismanaging or misappropriating these assets, that you're doing what a reasonable person would do with basic knowledge of finance, that they grow in perpetuity. And so oftentimes what they do is they rely on CPAs to talk about these plans. And it is a great opportunity for people who are coming in and doing these employee benefit plan audits that are required on an annual basis, is to sort of touch base on these things and maybe give a couple of pointers like, maybe this should be handled a different way. Maybe your disclosure isn't as clear. There are certain ways that you can benefit it. And in that way, we as your CPA can actually help you grow as an individual. And so that going forward, you can do this and you can provide that same benefit to your employer. And that's really what I think we see the most benefit from is realizing that we're sort of passing on that knowledge to, hopefully the next generation, or at least from you to the next person who handles your job. But there are also, as you mentioned, with fiduciary requirements, there can be mistakes. Like, for example, if you didn't accurately set aside money for a plan and you do have a liability for it, you do have a certain timetable within which you can make this correcting adjustment. So it's very important that you understand exactly how much you're setting aside. You need to have a knowledge of what it is for each employee, because they can be set up very differently. And so you know that when you set that aside and you create that liability on your books, you know that that is actually what you're required to pay as an employer. And if that number does not reflect it, you do have to take corrective action, or else you might lose your qualified status with your plan. And we don't want to go through all those complications. And that's definitely beyond the scope of what this presentation is supposed to talk about. But essentially, a qualified plan is something that's recognized by the IRS. And they say, you're doing this in accordance with what our legal system sets aside. You're doing it in accordance with this IRS code, and you're handling these fiduciary responsibilities going forward. And there are definitely some penalties that you want to avoid when it comes to these plans. And so it's very important to stay in compliance. And so you want to make sure that you're monitoring those very closely as an employer. And if not, and you do have to have these things, it might be worthwhile having someone consult and discuss and make sure that you are actually accounting for these appropriately. Now, as a trusted advisor, another thing to talk about is we spoke about these costs for administering these plans. So as an advisor, there's typically a growth cycle that we see for any sort of a business. You might start out with a very simple retirement plan. It might be, a SEP or a simple, something like that. Something that doesn't have that Form 5500 requirement, because that is a very large hurdle, and that's a large cost associated with a retirement plan. And so it definitely wouldn't be the best way for someone like a small sole proprietor to go about doing it. And so there are these costs to administering a plan, and there's also this benefit to your employee. So as we'll see, I believe in the next slide, we'll go over an example of this. But what we want to see is maybe it's worthwhile to talk to your accountant. Is there a benefit that you can have from adopting a new plan? Maybe it costs a little bit more in compliance, but maybe you do save some more on the end, on your end. So yes, as you see here, this is a simple IRA for an employer with 10 employees. So as you can see, the average wages for an employee are 50,000, and the owner wage is 100,000. And they have this 3% matching plan, and that's going forward. And so when you go through the computations, you see your owner match, that 100,000 times that 3%, you get 3,000. And then you have 10 employees, you got that 3% of 50,000, which comes up to 15,000, which comes to a total cost of 18,000. Now, this is a deduction that you can take on your books. This is your employer contributions, and sometimes what we advise our clients when they actually do have income, and this is a common planning tool, is using it to invest in fixed assets. Well, maybe your best use of your money isn't necessarily buying a new computer or investing in some leasehold improvements. Maybe it might be worthwhile considering moving to a different plan. Maybe the plan will actually help you retain better employees. And so that's a very important consideration that you might want to have a conversation with an advisor about or look into if you think that you have that situation. And we say that at the end, sort of this, compare this to buying equipment and taking Code Section 179, which is essentially writing off new qualified property. And so you get to take a dollar for dollar reduction on your expenses on your tax return for that. And David also spoke about that, and they did a little bit in talking about sort of that in state compliance, because certain states may not comply with bonus depreciation, but a lot of them do comply with Code Section 179, which is a federal deduction. And lastly, we just sort of want to talk about what this timetable looks like. What kind of timetable do you have as to make these contributions to these plans? And I think everyone knows this year we did have an extension due to the COVID for times to make your contributions to your IRAs, your Roth IRAs, because typically those fall on your federal tax deadline, which is 4/15. And so that is what the April 15th is typically when you have to make your contributions to your individual retirement plans. And that, I'm not going to say that goes the same for all clients, but that's typically what we see is that it comes due at the time that you actually file your tax return. And so some of the common ways that we see people ask us as an advisor regarding these retirement plans is maybe a self-employed employee doesn't know what kind of retirement plan options they might have. It's a very specialized field. They don't know what options are available. They don't know what forms they might have to look into, where it would show up on their tax return. And so these are sort of simple ways that we can help them out and sort of impart that knowledge. And I think the most common one that we see is this notion of what kind of required minimum distribution do I have to take? Because once you do meet this threshold where you have to take these requirements, and I believe Helene spoke about it earlier, we do have this life table. It's an actuarial table which says this is how long we expect you to live. And so you have to take the total amount within your account and take those distributions according to that lifespan on that actuarial table. So that's also something that we'll see, and it's also a complication with inherited IRAs, and anything that deals with inheritance and that stuff is something that has a little bit more complications just because of well, anything dealing with death actually has a little bit more complications in the tax code. So briefly, we just sort of want to talk about what our firm does offer, but we do have a small business team that does sort of deal this trusted advisory services. We do offer payroll services in this form of retirement plan contributions, deferrals, and we also do assist clients when it comes to setting up these plans. So these are all things that you might want to consider talking to an accountant or someone who understands these legal ramifications so that you do know exactly what you're getting into. Because there can be some hidden costs that you might not be aware of that someone who has been dealing with payroll for a long time might know about. And lastly, just as an individual, you know, it's very important for us to save for retirement. Typically, I encourage everyone, especially early on in their career, to set aside money and put it in a Roth IRA, simply because typically we're going to have a higher tax rate going forward. But even once you're at the highest earning potential in your 40s or so, it is an important tool that you might use in setting aside money into an IRA, making sure that you have that money for retirement. Because Social Security is not going to be there. There's a lot of problems with Social Security and adjusting it for inflation. There's been speculation about moving to a chained index for this cost of living for Social Security, so we might not even see the same increases for cost of living that we have seen up until now. And that's just a way that Congress is trying to make sure that Social Security can be stretched out longer, because we do have so many people from that baby boomer generation coming into Social Security, and that's where a lot of this problem comes. So really, if you are not from that generation, it's important for you to start taking advantage of your 401k in particular, but also setting aside this money into a Roth or an individual IRA. It's a very powerful tool. It is a useful way of deferring taxes, or making sure that you do have a tax advantage when you do retire. And so, does anyone have any questions about that? I know that was a lot of information. Feel free to type them into chat or raise your hand.
Certainly, and you can unmute if you want, if there are any questions. Great. Thanks, everyone. Thank you, Ian, for giving us that overview of how it affects us as accountants and advisors. We're going to move into an overview of what the types of plans that there are. So I'm going to take a minute and do a screen share in just a second. Ian has been referring to some of these terms for us. So now we want to kind of get a better sense of the different types of plans that are out there and the different components of them. So this screen, of course, talks about IRAs and 401ks and a Roth. So Roth is a type of IRA. We're going to go on into, hopefully you can see the screen that it shows us that there are types of retirement plans that I would like to spend a few minutes going into some of the nuts and bolts about these different plans. IRAs and IRA-based plans are a one general category. Other qualified plans is another category. And as Ian showed us earlier, the IRAs are not as complicated or as far as their reporting requirements and some of their rules. They are still governed by ERISA. They're still required to be in compliance. So you will get in trouble if you don't follow the rules, but their rules are easier to follow. Other qualified plans get more complicated. So we're going to spend some time talking about those different types of plans. I'd like to start with why it matters of what types of plans we have. And the real nuts and bolts of why it matters of us understanding as accountants what the different types of plans are has to do with how much can be contributed to a plan on an annual basis. So what I want to start off with is by using these terms, let's say, how much can an employer put in each year, or an employee, or an individual, for each type of plan? So it gives us some context. Why is this important? So at the top of our slide, you will see that if you've just got an IRA and that's all you have, you can put up to $6,500 in 2020 into that IRA. If you're over 50, you can put $1,000 or more. If you are an employer that has a simple plan, we're going to talk about what a simple plan is. That stands for something. It's not just simple. It stands for something. We'll go into those details in a few minutes. You can go up to 13,500. That means that can be put in for you. It can also be matched. So we'll talk about those details in a minute. If you have what we've referred to as a 401k plan or a defined contribution plan, you notice the big section in green. This goes into a lot of detail, and we're going to hit it one by one. But basically, if you go to the bottom, the total DC and SEP with catch-up, that means that for an entire year, the total that can be put in for you, if you're over 50, could be 63,000. If you're under 50, you can put in 57,000 in a year. That is a combination of employer dollars and an employee deferral, the 401k part. So we're going to get into this. And then we haven't talked a lot about defined benefit plans because they are not as popular as they used to be, but you will greatly see how important it is to understand that a defined benefit plan has a limit that's much higher than any other type of plan we're going to talk about. And that means that for an annual basis, the maximum that could be put in for an employee could be $230,000 for 2020. Obviously, those numbers are a lot bigger, and that's why it gets more complex. Understandably, there's a lot of money to be setting aside for someone. So I just want to give you a perspective on, depending on the type of plan, those are the types of dollars that we would be talking about. This slide is definitely available in your resource materials. So I'm going to stop sharing right now so that I can kind of go over each of these. I was hoping that I'd get to look at you. I did this with an idea that I was going to be able to see everyone, but they encouraged us not to. Let me put my camera back on. So it just makes it a little more awkward, but I was hoping to be able to see everyone. So let's talk about those different types of plans. Let's start with an IRA because that is the most basic. And for many employees, if they don't have a retirement plan offered at work, that is their only option. So that's what they're going to be contributing to. If you're not offered by an employer plan, then you can contribute up to $6,500 per employee. If there's a married filing jointly couple and one spouse doesn't work outside the home, doesn't earn a paycheck, there are possibilities that spouse, some money can be contributed for that spouse. It has subject to limits. It's based on taxable compensation for the family, and they are, like I say, there are some limits. Also, there are limits to how much can be contributed if you choose not to participate in a plan that's offered by your employer. If you want to contribute to an IRA, there are some limitations based on your adjusted gross income. And these are listed in the resource manual that we provided. Basically, if you're single, you can participate in an IRA even when you're covered by an employer plan up to adjusted gross income of $75,000. For married filing joint, you can contribute. You can have a retirement plan for yourself, but you can also you can participate in an IRA if your adjusted gross income is under $124,000. It's important to understand with a Roth IRA that they are made with after-tax dollars, which means that the earnings grow tax-free and the distributions are not taxed when they come out. You pay tax when you put the money in, so it's not tax advantaged when the money goes in. But oddly enough, they're still subject to the IRA limits. There's still limitations on Roth IRAs, and that's why we talk about that Form 8606. You have to track what goes into a Roth IRA to make sure you're not abusing the limits. And that Form 8606 that Ian referred to earlier is tracking when there are contributions made into certain types of IRA plans that were over the limits. What happens is you end up with basis in some certain IRA plans, and so it affects the taxability of when it comes out. I'd like to move on to the next plan, which is called the Simple. That stands for Savings Incentive Match Plan for Employees. So a simple IRA is still an IRA plan, but it's a way for an employer to start offering a retirement plan without having to incur a lot of cost for setting it up. To set up a simple IRA, all you have to do is basically fill out an a form that's provided by the IRS. It's called a 5305 simple or 5304 simple, depending on where it's funded. The simple plan allows you to not have to do that annual 5,500 filing requirement, but it still allows you to set aside money for employees and for yourself. The rules, though, is that you either have to match anywhere from 1% to 3% of compensation, or if you choose not to do any match, let's say some of your employees don't want to defer any money and you're not going to match, because if you're doing a match and half your employees don't contribute and you still want to help your employees, you can make an option to say, okay, well, I'm just going to put in 2% of everybody's wages so that everybody gets a little bit into their IRA. Those are the options with a simple IRA plan. You can contribute what's called a non-elective contribution of 2%, or you can contribute matching of 1 to 3%. And you can change that percentage each year if you want to. You just need to fill out the paperwork. The price tag for this simplicity is there's inflexibility. The IRS has specific rules, and you just have to follow those rules to stay compliant. So if you want to set up a simple IRA plan, all you do is fill out that form. It's like 2 pages. You tell your employees that you've set up the plans, and then you set up an IRA account for each employee. Similarly, a SEP plan is a plan that an employer can set up for employees. It stands for Simplified Employee Pension Plan. Now, as we said, the simple, you can contribute up to $13,500 for employee, but a SEP is more, the limits are much higher. You can contribute up to $57,000, but the point to remember for a SEP plan, Simplified Employee Pension Plan, is employees don't defer. You can't put employee money in it. It can only be employer dollars into a SEP plan. The limits are higher. You don't have to do a Form 5500, but each year you can only contribute a uniform percentage of pay for each employee. So the price tag for this SEP plan is you have to give the same percentage to each employee. You can change that percentage annually, but you have to do the same. That's the price tag for that simplicity. I'd like to pause for a moment and see if anyone has any questions about those 3 types of IRA plans.
No, but I just wanted to briefly touch on it. I think you had made a great point, was this sort of limitation for earned income when you're talking about making these IRA contributions. I thought that was an excellent point, because you do have to have earned income in order to make these deductions.
Right. And before we go on, I want to see if I can share our next code word. So our next code word is Bermuda. Bermuda. All right. Let's see if I can get back to here there. All right. So we're going to move on from those three types of plans. And then we're going to go into a more, thanks, David. We're going to go on to the non-IRA based plans. They are a bit more complicated in certain ways, but I kind of want to put it in perspective for you. They do require formal documents. You have to keep those documents compliant with the changing laws of ERISA, which means that if ERISA changes the game plan, then you've got to modify your documents to stay compliant. The Form 5500s are required for any plan that's not an IRA based plan. So that 5500 requirement applies regardless of how many participants there are. Ian referred earlier to whether you have the over 100 participants requirement, and that refers to whether your plan requires an audit. So if you've got more than 100 people participating in one of these plans, then you are going to be requiring an audit. And that's where our employee benefit plan specialists in our firm really come into play. We've audited several employee benefit plans. And that's, again, it gets very technical. And today we just want to make you aware that that's the requirement. The audit requirements when you get over that 100 participant threshold. The discrimination testing can be mitigated with some safe harbors. Those can be written into the plan documents. Some of the factors we need to consider for these type plans. However, even though there is a price tag for putting these plans in place, the beauty of some of these plans is you can put in flexibility. If you want to have certain features about what you cover for employees, a well-designed and a well-written plan will provide you an incredible amount of flexibility. The main thing that we as accountants and as auditors and as trusted advisors need to be aware of is being aware of what the fiduciary responsibilities are. Then that's where you really want to make sure we get a good comfort level with some of the fiduciary responsibilities. There are prototype plans available. A lot of financial institutions do offer what they call prototype plans to make writing those contracts easier. Those prototype plans do stay current with the tax laws. So if they know that there are changes in ERISA, they will let you know that, oh, wait a minute, we've got to do an amendment to the return, and they'll help you do that. I'd like to move on quickly to talk about what a defined benefit plan is. That's the first type that we're talking about of these other qualified plans. As we mentioned earlier, those were the first types of plans. Prior to the 1978, all the retirement plans were defined benefit plans if they were qualified plans. They would promise a specific monthly benefit when you retired. And actuaries had to determine what the employer's contribution was. There were no employee contributions into defined benefit plans. The key point in a defined benefit plan was that the risk of investment rested with the employer. That's why they got so expensive. That's why it put a lot of businesses in peril, because they couldn't keep up with those rising costs. So what has happened over the years is in 1978 was when the legislation was introduced to introduce sharing the load of defined contribution plans and the 401k provision where employees can defer part of their income. So those two provisions came in together in 1978. Defined contribution means that the employer can say, oh, I could put in a certain percentage each year or a certain amount each year, but it's not going to be so much that it's going to make me go bankrupt. And also, the employee can put some skin in the game too. The employee gets to defer some of their own money and it's tax advantaged. So it shifted the risk with these types of plans from defined benefit to defined contribution, shifted the risk of investment away from the employer over to the employee. And as we talk about those buckets, again, it helps to recognize your long-term retirement needs to be filled with several buckets, and that Social Security certainly can play into it, but it's really just a very small part of it in general. When we're talking about these defined contribution plans, we are talking about, you may hear different terms. They are referred to sometimes as a profit sharing plan, a money purchase plan, employee stock ownership plans. We hear of those called ESOP plans. A lot of them are defined contribution, 401k plan, a 403b plan. You may have heard of that. Most of the time when you hear of a 403b plan, you're usually hearing that in the context of a nonprofit entity that has set up a plan for employee deferrals. We have, but nonprofit entities can also now set up 401k plans. So you'll hear some of that. But most of the time, if you hear of a 403b plan, you're basically talking about a nonprofit entity. And then the different types of what's happened now is, because these plans have been around for a long time, defined benefit plans went out of favor for a long time, but we are seeing defined benefit features coming back into vogue again. When you looked at that chart and saw, oh, I can contribute $200,000 to help somebody's retirement. For very successful companies, sometimes that's an incentive to retain employees. There are reasons to have that. So what's now been introduced are hybrid plans, and you will see them becoming more popular, and we're going to see more of them. They have features of defined benefit plans and defined contribution plans. And these hybrid plans, sometimes they're based on what's originally started as a defined benefit, but it's got some features of a defined contribution. Sometimes it's a plan that is started as a defined contribution plan with some features of defined benefit. The details of these types of plans are beyond the scope of today, but I want you to be aware, if you hear of these type terms, you're probably hearing about a hybrid plan. So a cash balance plan, a pension equity plan, an age-weighted profit sharing plan, a new comparability plan, or a target benefit plan. So again, these are types of hybrid plans. Just wanted you to be aware of them. The next feature I want to talk about retirement plans is that when you have a retirement plan, the definition of compensation is a key term. And you think, oh, compensation. Oh, well, that's what I get on my W-2. Yeah, but on your W-2, you've got 3 boxes: box 1 wages, box 3 wages, and box 5 wages. So it's like, well, what's the compensation? Well, just like anything for an accountant, the answer is it depends. And for a retirement plan, compensation is defined by the document, and it's going to vary by document. For most simple IRA plans, compensation generally is going to be basically your Medicare wages, not box 1, but generally box 5 wages. There are exceptions. There are some financial institutions that write simple IRA prototype documents that are slightly different, but generally your wages are going to be Medicare wages for a simple plan. But it becomes more complex if you go into a plan that's got a formal document that's been done by a professional, that's been written to achieve certain reasons and certain goals. So you always have to look at the document for how compensation is defined, and compensation can be defined differently for employer contributions versus other aspects of the plan. That's where it gets complicated pretty quickly. These computations are also more complex if you are self-employed or if you're a partner. So, like to pause for a moment and see if anyone's got questions about these types of plans, because I think we can go into a fair number of questions here. And I don't see any yet. Okay. I'm going to go ahead and go early into our next code word. Our next code word is deferral. D-E-F-E-R-R-A-L. I'm going to stop sharing, I think. Let me see if I can manage to do that. Or did I not share that? Hang on. I don't think I shared that. Let me do that. Yeah, let me share that. Sorry about that, guys. All right, that's our next code word. All right, so what I'd like to do, we've got a little more time than I thought, so I kind of we're going to end up going into what's new a little bit earlier than I thought. I want to point out to you that in the resource guide, and I didn't put a screen here because it doesn't translate well on screen, but on towards the back of your slide is a nice chart that shows the different types of plans that are available and what the contribution limits are and what the employer contributions can be and when they need to be paid in. And when Ian was referring earlier to when you can make contributions, for many plans, the employer contributions can be made up until the due date of the return with extensions. So that gives you some flexibility of getting your contributions in. Employee deferrals, in other words, I want to put my money aside, that has to be put in by December 31st. That has to be on a calendar year basis. But the employer side of what they're going to get a tax break for on their tax return can be paid in by the due date of the return in most cases, and that's with extensions. All right. So I'm going to open up our next slide. So we want to look at a little bit of what's new with retirement plans. And as you've already heard from some of our other sharing from our other segments this morning, the Secure Act, setting every community up for retirement enhancement, was the most sweeping update of retirement legislation and since 2006. And we've touched on that a little bit in the earlier sessions this morning. But it was a product. Let me get my camera back on. It was a product of a bipartisan effort to make retirement savings more accessible for more people, and especially for people who may not have been participating in retirement plans earlier. Many features of the Secure Act address some of those technical portions of qualified plans. These are some of the components where Congress was trying to make retirement more accessible for more people. Some of the provisions include an employer is allowed to adopt a plan and make those contributions, again, as I said, up to the due date of the tax return, including extensions. There are some tax credits available for some of the startup costs of setting up a retirement plan. You also can get a tax credit if you adopt an automatic enrollment arrangement. An automatic enrollment arrangement means that when you set up a plan, you automatically enroll your employees in, and in order for them not to participate, they have to affirmatively choose not to participate. So that's encouraging people, trying to get as many people to sign up as you can. It also provides an incentive for small employers to set up safe harbor plans that we talked about. They're less expensive and easier to administer. And it also enables, if you as an employer don't want to go through the expense of setting up a plan, the Secure Act provided some provisions where small business owners can actually join together to offer multiple employer plans. That's it's a concept that's been around for a while, but it used to, a lot of employers didn't want to do that because they might be held liable for the mistakes of another employer. But the Secure Act passed provisions to try to make it where the mistakes of one bad apple don't necessarily ruin it for all of the other participants. So that's sometimes an option that you might want to consider. The Secure Act also affects individuals in certain ways. As they mentioned this morning, that it changed when required minimum distributions have to start. It used to be age 70 and a half, and now it is age 72. If you want to make an IRA contribution, they used to be denied for people who were over 70 and a half, and now the government said, nope, you can keep doing it. For an IRA, you can keep doing it. If you make the money and you want to set it aside, you can do it. So it repealed the maximum age for traditional IRA contributions. Again, traditional versus the Roth. Those are the traditional IRA contributions. In prior years, part-time workers were not really eligible to participate in 401k plans, but the Secure Act relaxed some of those provisions. If you're a long-term part-time worker, you may be eligible to participate with employee deferrals into a 401k plan. This morning, they talked a lot more about the stretch IRAs. A stretch IRA means if I inherit an IRA and I am and under the old rules, maybe I could take that IRA out over my lifetime. But if what the Secure Act did was saying, no, we want you to, if you inherit an IRA from a parent or from a grandparent or someone, we want all of that money to be distributed over 10 years. Now, it doesn't have to all be distributed in equal amount, but by the end of the 10th year, it needs to be completely paid out. It means you could pay it all out in the 10th year if you wanted, but the IRS is saying that needs to be paid out within 10 years. But there are exceptions for that. And as I mentioned earlier, one of the exceptions is if you have a special needs child, that person can qualify not to have it taken out over that 10 years. There's some other exceptions, and don't have them all in front of me, but I know that that's one of them. And we're getting a lot more questions about that, so it helps. I'm glad that they put that provision in. And then there's some also, you can take out up to $5,000 for qualified birth or adoption distribution. So these were all parts of the Secure Act of 2019. Ian, would you like to take the CARES Act?
Sure, I'd be happy to. Thank you so much, Celia. So yes, the CARES Act, the Coronavirus Aid, Relief, and Economic Securities Act. It obviously signed into law on 3/27 in response to the global pandemic. So in essence, what the CARES Act did was it waived the requirement for minimum distributions from retirement accounts for people who were required to receive them in 2020. It also, as I believe Helene mentioned earlier, there were some circumstances where if you were actually paying for healthcare costs associated with time off or dealing with the coronavirus, there's the ability to have a penalty-free distribution and to get around that 10% early distribution penalty that we normally see. And then also, it increased the maximum amount that may be taken out from as a plan loan from 50,000 to 100,000, and it provides payment relief for outstanding loans. And essentially, what they allowed you to do was take it out and avoid this penalty, and so that's what they did, was allowing you to get this without having that 10% penalty. So I definitely want to save enough time for questions if there are any. So I just want to briefly mention who you might want to see if you have any questions about an employee benefit plan. We have some firm experts here that you might want to consult. One of them being Jennifer Lehman, another one being Kevin Keller, and I don't know if Celia wants to bring up the screen real quick just to share that with the names for you. And the other one is Matt Hale. And then if you're talking about tax issues related to these employee benefit plan, you can speak directly to Celia or to Rich Basofsky regarding these. Sorry, that was my coworker trying to sneak in on the camera. But yes, there's also a couple of other things that we didn't talk about that are some benefits that you might see with these retirement plans. For example, when you're buying your first house, they do allow you to take some distributions directly from your retirement plan when you're doing that. So even if you're setting aside this money for retirement, you can also use it for some very important life decisions, and they are also providing that benefit for you going forward. So, there are a lot of opportunities to use these retirement plans, and there are definitely some considerations that need to be made.
So I'm going to come back and revisit a couple of comments because we have more time than we thought. And I want to talk about, as Ian said earlier, retirement would be maybe for many people the biggest expense of their lifetime if they happen to live longer than they retire than it used to be when Social Security was set up. So in other words, right now we are expected to live in the U.S. between 18 to 20 years after we retire, if we are to retire at the average retirement age of 67. When Social Security was set up, I'd like to just give you a couple of some age facts. It was set up in 1935 when the average life expectancy was 60 years. And the normal retirement age was 65 years. So if you do the math, basically the statistics was that you weren't going to live to retirement age. You were going to die before then. But if you did live to 65 years, the averages were that you would live another 12 years. So Social Security was set up and funded with the idea that there was a small percentage of the population that was going to live that extra 12, and there needed to be some kind of backup. So it wasn't designed, but now most people are expected to live a lot longer. Now the average life expectancy, instead of being 60 years, is 79 years. And the normal retirement age is it's only a little older. It's about 66 years. So being aware that when it was set up is very different from how it is now. And that's why we keep referring back to those buckets, that you're going to work a long time, but then you're going to live a long time after you stop working. And if you're only relying on Social Security to help fund that, you're not going to have a very big bucket. You need to have more buckets to choose from. Again, going back to where the history was, those early retirement plans, as Ian said, was they were driven by the plan features were driven by employers, especially that vesting schedule, that 20 to 25 years. Well, now vesting schedules are closer to 5 years, so it's really come a long way. It's not those 20 to 25 years. That's in keeping with the fact that you can work at an employer for 4 to 5 years and be fully vested. And that's keeping more with the trends of today, where you may not work with an employer your entire career. So that was important.
And Celia, I think we're coming close to our scheduled close time of 2:40.
Perfect. Good.
So
Just want to
if
make sure.
anyone
We need
has,
one more code word then. Let me give you that. Hold on. Let me share that. All right. So our last code word, Aruba. Aruba. Can everyone see that? So again, I hope that these resources prove to be helpful to you. And we are welcome to have any questions. You feel free to unmute yourself if you have any questions or if there's anything that we can be of help for. And if not, we'd certainly appreciate everyone coming today.